Let's go now to our friend Bimnet Abibi from Galaxy Digital Trading. My friend, how are you?
Good. Thanks for having me on.
As always, and I'm excited to talk because it's been a pretty exciting week. I remember last week we talked about higher for longer, a little bit of a repricing of the interest rate curve, but then there was some data that came out last week too that really caused equities to not do great. What happened?
So you had a pretty strong PCE print.
That's not CPI. What is that?
That's personal consumption expenditure.
Yeah.
Is the Fed's preferred inflation measure, and it printed a 0.5 month on month, which is a really strong reading.
0.5 month over month inflation?
Yeah.
Wow.
0.5%.
That's what I mean. Yeah.
Yeah.
Wow. Though that's notable.
I don't know. That's definitely pretty
And then what?
meaningful.
You annualize that to get to like the annualized. So,
yes.
Yeah.
But it's you don't annualize. It's the past 11 months of data combined with the current data to get your annualized.
But that was a bad reading.
Yeah. It basically confirmed what you had in the CPI reading, which is also 0.5 month on month. And so generally speaking, prices are rising at 0.5% month on month, around 6% a year. Which is not good, especially given that you've had somewhat tight monetary policy for the past 9 months.
You'd think it would be having more of an effect. You'd hope. You would hope it would be. Yeah.
So right now, I mean, today you got ISM prices paid that came in a lot stronger than expected. You had a 51 handle print when I think expectations were for like 47. So that's showing resilience in prices again. And what you've had is a further repricing of rates. And so now you're looking at terminal rates that are around 547, 550 area, which is higher than what any Fed person has really been talking about. So this is really one of the first few times where the market's aggressively getting ahead of the Fed.
Yeah.
And that's kind of what's caused equities to come off a bit. And I'd also reiterate that cash is, again, a formidable alternative to owning any risk asset right now. When you can earn, 4, 5, 6% on low duration stuff at no risk. Why take the risk of going into a risk asset?
Right.
So,
and the risk is, just to be clear, with you're talking about a treasury.
It's just government default.
The risk is that the U.S. government defaults. That's the risk that exists, right? Unlikely.
If you talk to an economist, they'd tell you that's the risk-free rate.
Right.
So, honestly, if the U.S. government defaulted, it'd be probably the best thing to happen to Bitcoin in a really long time.
Yeah, I mean, it's one of these things
I'm dead ass. I'm lifting Bitcoin hand over fist if the U.S. government is defaulting. There are some scenarios where it's causing a big risk asset sell-off, but I think if people are going to start doubting money and the viability of money, Bitcoin seems like a pretty natural. Gold is probably the better. I mean, this is probably the better risk-adjusted trade.
Yeah.
In that instance, but
Bitcoin has a role there.
I think with respect to the U.S. government defaulting, we don't have to spend that much time.
Right. I just throw that out there as the.
But yeah, it's really an event that is going to start impacting the market now. What it will lead to is this thing called extraordinary measures that the Treasury adopts.
And haven't they already been adopting? Right? Because we're already at the debt ceiling.
Correct.
But I think Secretary Yellen had said they can do those through July or something.
Yeah.
So technically, the politicians can.
Yeah, you can get through July, probably September, et cetera.
But at some point, obviously, the Congress has to figure this thing out.
Correct.
We're talking about the debt. They have to raise the debt ceiling.
But what happens is normally the Treasury likes to keep money on the chance that they have outflows.
Sense. Yeah,
right?
That makes sense.
I think the minimum they keep, or it fluctuates, but it's they need to keep 5 days worth of outflows potentially in their account.
Yeah.
Right, and then a buffer, et cetera. And it moved around with COVID and stuff because the government had more things that could possibly spend money on. So what happens is the Treasury is we don't have a huge debt limit, so we're going to keep a minimum cash amount on hand. And what that does is that takes Treasury supply out of the market, and it's a weird technical thing. But long story short, it shouldn't really impact the market that much. It's well telegraphed. Every year that I've been in markets, it's oh shit,
the debt ceiling.
Oh shit, the debt ceiling. Notice that one T-bill just spiked in yield by a couple of basis points.
But they figure it out.
Yeah, they figure it out. Anyway, let's get back to
you're talking about risk assets, owning them over
well,
equities.
So high level, we have data that's really strong, prices that are still continuing to rise. But the prices that we're most concerned about are like the service sector related stuff, not the goods.
Yeah.
And the service things are still going to be tied pretty closely to employment, and employment's still at record lows.
So people feel
inflation's sticky.
Yeah, because people are willing to pay higher prices still, right? And that's because people feel they don't feel poor.
They don't.
En masse. And that's because they have good jobs.
And credit cards.
And their mortgages, if you have a home,
locked in. Yeah.
You're locked in at a low rate, and home prices have been appreciating in a lot of places.
Or not depreciating that much.
Or holding pretty good. Yeah. We were just talking before we started recording about this data that people are looking at, which is the new mortgage applications.
Yeah, I think they're down about like 40% year on year.
And it's at their lowest for decades.
Yes, correct.
So no one's taking out a new mortgage. Not no one, but very few people are taking out a new mortgage because the rates are so high.
Correct. But it's also, there's just, yeah.
But the wealth effect, right? Because if you have a home already and you can afford the mortgage because it's locked in at a lower rate, and the home is appreciating or holding its value, and you have a good job, right?
You're fine.
Like you feel like you can spend money, and so you do.
Because your disposable income
now, even if you're losing money in real terms because of inflation, which many people are, right? Because real wages aren't actually keeping up with inflation.
They're not. But the other thing,
but like still though, you feel like you're doing well, right? And that's so much of this is like, do you feel like you can spend money?
Here's the other big problem that I don't think the average American or the average person has really kind of gotten their heads. But like all the money people keep in their checking accounts and saves is earning nothing.
Yeah.
Right. So you're getting depreciated on your fiat if you're not in these bills at this point.
So you either spend it now or invest in instruments, right?
Yeah.
Like in treasuries or
keeping
equities, theoretically.
Keeping it in a bank account is probably the worst thing you can do right now.
I will say I saw there are some of the brokerage firms, obviously, because they run like money market funds. And there are sort of cash-like instruments like that feel a little bit like a savings account. But again, you're actually investing in like an institutional money market fund or
like Marcus offers
bond fund. Yeah. So like, but yeah, the banks weren't they asked? When they had the bank CEOs, like when was it? Maybe in December or something before Congress, they asked some congressman or senator asked them like, why is my like a bank account paying 0.1% interest? And they're just like, oh yeah, like we're
competitive.
Like blah blah blah, and then it's like we're taking all that money.
Yeah,
the bank is
that's
making
really
all that
what
money.
it is.
Yeah.
But anyway, so services inflation's hot. Home prices, they haven't, and like rents, they haven't been coming off aggressively. And in fact, like the last CPI print, we had a 0.8 print month on month on owner's equivalent rent. And we know that's backward looking. And Nick Timros, who's like the Fed reporter at the Journal, like all the Fed people like, he recently published a piece earlier this week about like apartments. And generally speaking, like apartment rents have been coming down, and you should start to see that in the data a little bit.
Mm-hmm.
And then the other thing to keep in mind is, today commodities are a lot higher, but like commodities have been getting hosed for the past couple months.
Energy in particular is
nat gas.
Oh my gosh!
Yeah, thank God for the warm weather. Feels like
middle
of spring in February.
It literally does. Even today in New York, where it's like a little chilly, it's still like 40.
Yeah,
it's not like 20.
But yeah, I mean, the whole commodity complex has come off. So the good side of things has really.
Remember when lumber was like
lumber.
mooning?
Oh yeah.
FTX launched lumber futures.
Oh, that's awesome.
Back then, when that was.
What didn't they launch that?
Oh my God,
it's crazy.
We should have known how degenerate they were separately. But let's go.
Hindsight.
Yeah. But yes, the commodities are off. The mortgages are sticky. People have jobs.
Sticky, but apartment rents are going to come down.
Yeah.
The services stuff might stay sticky. I mean, I think that the U.S. inflation stuff is just a little overblown right now. Like prices will come down. Like having interest rates this high, like
it has to have an effect.
It has to have an effect, and it's also ongoing quantitative tightening, which is draining $95 billion of liquidity like every month.
Mm-hmm.
It's not just the U.S. doing it. It's like globally, like everyone's trying to slow shit down. What throws wrinkles into all of this is the Chinese reopening.
Yep.
And so, basically, like today, it was pretty big news. You had Chinese data that was really robust. So expansionary PMIs was, the headlines overnight. And long story short, you've got a nation of 1.3 billion people that's been saving money for 3 years. and now they can go out and do stuff and spend money and not wear masks, etc. You know, there's some interesting terms that people like revenge spending.
I like that one because I feel like I did that when our lockdowns really lifted here.
Yeah.
Yeah, that makes a lot of sense. Okay, so just I'm looking at the block clock over my shoulder. We're at 23.7 here today on Wednesday, but Bitcoin and crypto has been pretty resilient, and actually Bitcoin's still been leading the way. I think we just updated our year-to-date numbers. Year-to-date, Bitcoin on a risk-adjusted basis still the best performer.
I would guess it's
better than
40% on the year.
Yeah, and still better than Ethereum, which has also been performing well.
Risk-adjusted, that Sharp is probably like something stupid.
Yeah. Even last week, right? I think it was the worst week in equities of this short year so far. But yet Bitcoin came down from like 24.8 to like 23.8. Pretty resilient here.
I think folks in the U.S. tend to get very U.S. centric about how they think about markets, and forget that Bitcoin is a global asset. And so I think part of the resilience in crypto has been related to kind of the influence in Asia or the crypto scene in Asia, right? With Hong Kong officially allowing
Hong Kong
unrestricted trading.
They put out a big regulatory framework that lays the groundwork for how companies can operate, and I mean very granularly. This is the thing we've talked about is what the U.S. has neglected to do, but UK has now done, Europe has now done, now Hong Kong has done. Again, a comprehensive framework that makes it possible and I dare say even easy for crypto firms to comply and offer services, right? Rather than a bunch of gray area stuff or God forbid, prohibition outright. Bullish.
I mean, I think that's been super constructive, whether it's in Asia or UK, as you mentioned. It's also, you've had a bunch of like Asian tokens that have done really well, like the Asian Polygon and the AI stuff. And and Korea also has a pretty active, crypto community. I mean, they're the people that pumped Aptos.
Yeah,
right?
Aptos was that's where they did their big conference. Yeah.
Oh, yeah.
They had their conference there in Seoul.
Absolutely.
So a range of global factors also being supportive.
Global factors, that's really supportive. And then I also just think you kind of just have to see who's left, right? It's an industry that came apart in last year.
Yeah.
And so I think you're left with a bunch of strong hands.
Right.
Like all the people that were
to be
selling...
clear, like the coins didn't get destroyed. They got moved from like forced sellers into buyers.
Yes.
And who's buying at those low levels? Well, strong people, long-term convicted.
Absolutely.
Right.
Like if you were scooping up Bitcoin at like 16, 17,000.
Yeah, you're not spooked by like 24.5 going down to 23.8 at all.
Oh no.
At all.
You're thinking like 5-10 years down the line.
Yeah.
And I mean, I love looking at the weekly and the monthly Bitcoin charts. Like, if you're taking a step back and taking a real big picture view, like the chart says higher, not lower.
Yeah.
And 18. What was the Bitcoin low? 16.5,
even
16.4?
lower. 15.8 maybe it printed at one point. 15.5
on a
even.
flash or whatever.
Yeah, like during that act. But yeah, like call it 16.
So, yeah,
we were at 16.6 for like weeks. It felt like at one point. But yeah.
But it feels like a bottom now.
Yeah, it does.
Structural bottom in Bitcoin, and I think there's a lot of investors that did not pay attention when it was at the bottom, and now you have a product that trades like there's a ton of dip buyers in it.
Yeah.
Like, to give you an idea, there's been 10% dip this year in Bitcoin. It was very brief. And then you've had a couple of like 5% dips. But this thing, for being a 60, 70 vol asset class, like has given people very little amount of time to actually like load up on BTC at good levels.
Yeah.
Right? If it's an asset that, I mean, 20K's got to be huge support.
You think so at this point?
Huge support at this point.
I mean, right now we're ranging between like 20K and the 200-week moving average, which has historically been huge support, which we're below, which is in the like 25 range, slowly coming down over time. So like that feels to me like the range at the moment.
Yeah, 25K is
and 25 just also as a mental
I mean, I think
conceptual number.
I think if you take out 25, you're going to 28, but it seems like there's some strong resistance at 25. I just think that it's one of those things that you need to own right tails in.
Yeah.
You don't necessarily have to own Bitcoin, but like I think you're supposed to own the right tail of Bitcoin, which is swinging options, or stuff like that, because I do think the FOMO is going to be pretty real.
When this thing moves, it's going to move.
It's going to gap.
Yeah, that's how it always has been, to be clear. That's just looking at Bitcoin historically.
In trading terms, the way you're supposed to think about it, it's always been spot up, vol up.
Yeah.
Right? And so when spot goes up, normally volatility goes up with it, because you get these like really gappy illiquid moves and FOMO, and people are short gamma and they got to cover. And so, I definitely think that there's room for that kind of move to happen, but it's going to be really tough for that to happen absent risk assets doing well, which is going to be, again, really tough because
got a big long story on
you're in a 5.5% interest rate environment now. And so it's tricky. Like Bitcoin, I think if we were in a 2.5% interest rate environment, would be
easier.
It would be a lot higher. But you can say that with anything.
We got the macro thing to worry about. That's
all
we.
The macro's a big.
It is for sure. This is a great conversation, Bim. As always, great to have you, and we'll catch you next week, my friend. Thank you.